What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. We're going to have some fun in this one, talking about whether or not infinite banking is a scam. And if you just want a quick answer to that question, the answer is no, absolutely not. It is not a scam. In fact, it is quite the opposite. It's one of the most powerful financial strategies, at least that I've ever come across. And this is coming from somebody that owns their own infinite banking policy. I implement the infinite banking concept in my life right now. It is awesome, guys. And I'm going to give you some specific examples about how I'm utilizing my policy right now. And then you let me know if you think this is a scam. It's just not. And I want to do this video because I think it's just really irresponsible. Like when I watch some of these videos, it's like people just don't know what they're talking about. It's filled with half truths, sometimes just straight up wrong information, the way that they talk about these things, and they leave so much information out. And it discourages people from learning more and researching a financial strategy that could potentially have a massive positive impact in their lives. And they miss out on all the benefits because they associate it with it being a scam now. You know, it'd be like saying, is flipping real estate a scam because people lose money in real estate? Is investing in the stock market a scam because people have lost money in the stock market? ETFs, mutual funds, cryptocurrency, whatever. Like, is everything just a scam because people lose money, or maybe there's something a little bit better out there for specific goals, whatever? No, that's just ridiculous. Now, are there scams out there? Of course. Are there bad actors in the infinite banking space looking to take advantage of people, maximize their commission? Absolutely. You know, so those things exist. It doesn't mean infinite banking is a scam. It comes down to how we set our policies up, because we're using dividend paying whole life insurance contracts, not IUL. It comes down to how we use our policy, making sure that we don't over leverage it and stuff like that. Right. But, it's not a scam. And to call it a scam just to, get more views and stuff like that, it's just ridiculous. Or sell more of your own product. It's just stupid. At the end of the day, I don't care what people do with their money. If you want to do real estate, stocks, you want to purchase an IUL, you want to do buy term and invest the difference, you want to do infinite banking, I don't care. Have all the facts, have all the information, understand how all these things work, know what all your options are, so then you can make the best decision for yourself. Just saying something is a scam and filling that video with half truths is just, it's irresponsible in my opinion. So there's really 5 main things that I want to cover and just kind of debunk, the reasons that people say infinite banking is as a scam, or whole life insurance is terrible, whatever. The break-even point we're going to talk about, we'll address the low internal rate of return. Oh, I can get much better returns in the stock market, blah, blah, blah. Here's a big one, the third one. Paying interest to borrow your own money. Have you ever heard that one before? Oh, it's a scam. You pay interest to borrow your own money. Why on earth would you do that? That's a scam. It's not. The evil life insurance company keeps all of your cash value when you die. This is ridiculous. And then also the arbitrage within the policy as well. Like if you borrow it 6%, your policy is only earning 3 to 5% net, whatever. Again, this is just half truths, guys. Half truths. Got to have all the information. All right. Now, I do encourage you to visit at the end of this video. I'm going to have a lot of supplemental training to this video, where I go into a lot more detail about these different arguments about why it actually makes sense to borrow. To pay interest to borrow against your cash value. All right. Why the arbitrage thing is it's a non-issue when you understand compound interest versus simple interest. So make sure you check out the links in the description. I'm going to have a ton of additional training on how infinite banking works. And again, I want you guys to have all the information, and then you can make the best decision for you on whether or not infinite banking makes sense or not. But let's talk about the first one here really quick. The break-even point for these whole life insurance policies. Dave Ramsey is really big on this. He hates whole life insurance. And I often hear him say one of the reasons is because it takes 20, 25 years for you to break even and get your money back. Basically meaning your cash value equals how much you've paid into the policy. Like it takes 20, 25 years. Well, that's weird, because my infinite banking policy is going to break even in year 4. So what's the difference? Like I thought Dave Ramsey said it takes 20, 25 years to break even. Why is mine breaking even in year 4? It's because you can structure and customize. You can design your policies to have a much earlier break even year, a lot more cash value. Like there's so many different ways you can design your policy. He never talks about that though. He's only ever talking about traditional whole life insurance policies, 100% base premium. Those do take a very long time to break even. And so if you're trying to get an early break-even point, you want a high cash value in your policy. You don't do a traditional 100% base policy. You do a 25% base and 75% paid up additions policy, or 1090, whatever. I don't care. It depends on what your goals are, right? But I mean, did you know that? Did you know you can decide where your money goes inside of your policy, whether it's to the base premium or the paid up additions, which is going to give you a lot more cash value. You can also front load the policy, which gives you an even earlier break even point. That's why mine's breaking even in 4 years. And it just continues to grow every single year after that. We net 3 to 5% tax free every single year. It kind of brings me into my next point. But the break even issue, it's a non-issue, guys. Like, it doesn't take 25 years. You can set these policies up to break even a lot earlier. Let's talk about the internal rate of return. That's another big one. This usually isn't associated with infinite banking or whole life insurance being a scam, but just a bad investment, right? A bad place to put your money. So first off, whole life insurance, not an investment. Infinite banking, it's not an investment. Infinite banking is the financial strategy. Whole life insurance, dividend paying whole life insurance, is the vehicle we use to implement infinite banking concept, right? But these policies, they typically net 3 to 5% every single year, tax free. Okay. Now, what that means is that it's a really good savings vehicle, or like bond alternative, you could say. You can't compare it to the stock market. You can't compare it to other investments because it's not an investment. And I mean, what savings account do you know that provides all of the benefits of a whole life insurance contract, that pays, that grows 3 to 5%, that has the guarantees and protections of whole life, the safety, the liquidity, access to that money, right? Like, you get so many benefits of it. What savings account does that? I don't know of any account that does that. Whole life insurance, it's the only thing I know that does that kind of stuff, right? So the other thing too, though, is you don't set these policies up for the rate of return. I always say that the rate of return we get in these policies is just a bonus. Again, it's how we use our policy, which I'm going to talk about at the end of this video, or towards the end, how I'm utilizing my policy to accelerate my wealth, to build wealth even faster because I have this policy. So it's not about the rate of return. It's just a bonus. The other thing too is when you're comparing it to other vehicles, like Dave Ramsey tries to do, buy term and invest the difference, buy mutual funds, whatever. You have all of the tax advantages of these life insurance policies as well, where it's going to grow tax deferred. You get tax-free access, all that stuff when you set it up right. So, rate of return, really, that's the road we're going down. I mean, the rate of return is just a bonus in these policies, guys. Here's one of my favorite. Paying interest to borrow your own money. That's a scam. Why on earth would you do that? That's a big one. So again, please check out the video in the description where I go into a lot more detail about why it makes sense to borrow. To pay interest to borrow our cash value. And the main reason, though, a couple of reasons, is one, when we borrow against our cash value, yes, there is going to be an interest cost to that, but it's a cost of doing business. The money in your account, the cash value in your whole life insurance policy is going to continue to grow 3 to 5% every single year, tax free, as if you never touched it, because you never did. You borrowed against it, and then you take that and you invest it. You buy an income producing asset. One of the examples one of the ways I'm using my policy is I'm flipping equipment right now, flipping like forklifts and stuff like that. Very similar to real estate. But if I could borrow at 5.5% over here, my money is still growing at 3 to 5%. It's compounding every single year. We're going to talk about this in just a second. It's going to bring me to my next point. But then I can make 10, 15, upwards of 30% over here flipping equipment. Well, now I've made money twice, and because my policy continued to grow. I had my investment over here. The only cost was the the interest, but my investment paid for that anyways. So is it not really a wash anyways? So I made money twice. That's why it makes sense to pay a little bit of interest to use my cash value, because it's going to continue to grow uninterrupted over here while I'm making this, taking advantage of this investment opportunity or whatever, right? And to segue to the next point of that is, when you understand how compound interest works versus simple interest. I did an entire video on this. Check out the description, guys. Man, it is so powerful when you have true uninterrupted compound growth, even if this is actually part of point 5 of no arbitrage. But even if the interest I pay on my policy loan is higher than what my policy is netting internally. The fact that my policy is compounding versus the policy loan is simple interest where I'm paying that down and the interest is being applied to a lower and lower balance, you actually still end up ahead. Now, again, this comes down to how you use your policy, right? If you like, I see people out there that say you never have to pay the policy loan back. While technically that's true because the death benefit will cover it, you absolutely want to pay the policy loan back every single time. This is infinite banking. Treat it like your own bank. Would you not pay the bank back if you got a loan from them? Why would you do the same thing to your bank when you start these policies, right? But again, I'm going off on a tangent there. I'm sorry, but back to my point about where you're getting compounding growth over here, but you have simple interest over here. When you run the numbers on that, like this just blew my mind, guys. It completely debunks this argument where like, oh, why are you paying interest to borrow your own money? It's actually really smart to do that. Again, when you're utilizing these policies correctly. So again, check out the link in the description for more of a deep dive on that. All right. The number 4, the evil life insurance company keeps the cash value when you die. So it's a scam. Okay. That's just not true. And I did training on this, but just a brief overview of why this is absolutely ridiculous is your cash value. Sorry about that, guys. A little bit of internet trouble. So what I was saying is your cash value is actually baked into your death benefit. So when you look at your policy, your death benefit grows with your cash value. So it's already baked into the death benefit. And my question would be, because your cash value is always lower than your death benefit up until like age 21. That's where they meet. But would you rather give your beneficiaries, your loved ones, more money or less money? Okay, because with the death benefit, they get more money than if they were to get the cash value. Also, would you like to pass that on tax-free, or do you want them to pay taxes on it? Okay, well, because you're passing on the death benefit, this is life insurance, that death benefit gets passed on income tax-free to your loved ones. If you were to pass on your cash value, any growth that you had, that would be the cash value minus whatever you put in, they pay taxes on that. That's I think it's capital gain. It might be income tax. I'm not sure. But anyways, do you want them to pay taxes or no? No, of course not. We don't want to pay taxes if we don't have to. So why are we worried about what happens to the cash value when it's already baked into the death benefit and it's getting passed on tax free? It would be like if you sold your house. Let's say your house is worth $200,000 and you have $50,000 of equity in that property. Okay, let's say you sell it for $200,000. Would you expect to keep the 200 plus the equity, the 50,000? No, you don't get both. You would get just that one part of it, right? That would be ridiculous. So why do we expect that we should get both the cash value and the death benefit? It doesn't make sense. So the cash value is already baked into the death benefit, guys. Absolute non-issue. And then I do want to finish up with the 5th point, the arbitrage issue. Again, I hear this a lot, why it makes absolutely no sense to do whole life insurance. It's a scam. And it's like, you borrow it this much and you only earn this. I alluded to this a little bit earlier, guys, but when you understand compound growth, number one, when I borrow against my policy at 5.5% and I'm netting, let's say 4%, on the surface, you might think that that's really bad. That doesn't make sense. That does sound like a scam. Why would I do that? When you understand compound interest versus simple interest, it absolutely makes sense. I did an example where I borrowed at 6%, only earned 4%, and I spread it out over like 5 years. Did it like for a car loan, whatever example. And the 4%, because it's compounding, actually had a higher dollar amount than the 6% simple interest loan. Like it's just crazy when you understand these things, how powerful this stuff is. So the arbitrage thing, okay, we're not worried about like if we borrow at 6, we're only earning 4. We're not worried about that. At least I'm not. Okay. The other reason too is we're not setting the policy up to get arbitrage inside of the policy. No, when I borrow at 5.5% and I go over here and I invest in a piece of real estate, or I'm like I mentioned earlier, I'm flipping equipment and I make 10%, 15%. Maybe I do a private money loan. I'm going to be doing that pretty soon too, where I'm going to borrow at 5%, 5.5%, 6%, whatever it is, and I lend it at 12% on what, and my cash value is still getting uninterrupted compound growth at that 3 to 5% tax-free. Guys, please explain this to me. On what planet does that not make sense? That's exactly what banks do. You put money in the bank account, they pay you a measly 1%, but then they lend it out at 5. That's exactly what we're doing here. With different variations of it. So again, it comes down to one, understanding the difference between compound and simple interest, and then two, how are we utilizing that policy loan? Like if we borrow at 5.5% to go on a vacation or buy groceries, which I don't that's just ridiculous. Well, I mean, maybe there's an argument for it at that point, but even still, like, man, again, there's so many benefits we get from this. The financial efficiency of not spending all of the cash and borrowing against the policy, money's still growing. It's really, really powerful stuff. But usually, though, when we're talking about the actual infinite banking concept, we want to borrow at whatever our interest rate is over here so we can earn more interest over here. But we're making money twice because we're taking advantage of our investment opportunity over here, and our cash value is still getting uninterrupted compound growth. So anyways, guys, I'll go ahead and wrap up with that. Hopefully that was helpful. I'll probably make a couple more of these videos addressing other points, arguments, claims, whatever. And yeah, just keep the conversation going because there's a lot of interesting stuff out there. So I hope this was helpful. If you have any questions, leave them down below in the comment section. I'd love to hear your feedback too. Make sure you check out the supplemental training on some of the other videos I did breaking down these various different points, guys. It just comes down to educating yourself, right? When you understand this stuff, maybe you'll come to the conclusion that infinite bank is not for me. It doesn't make sense. And that's fine. But you got to have all the facts, all the information in order to actually do that. Because you might realize, like I did, that this is a very, very powerful financial strategy, guys. I absolutely love it. So I hope you're crushing it. And I will talk to you in the next one. To your success. Matty Ice is out.